Okay, so good evening, class. It is February 27th. We are going to be covering Chapter 10. Chapter 10 is specifically capital projects and project analysis, with an emphasis on evaluating the cash flows of projects. This is an area that I do have quite a bit of experience with. I worked in project portfolio management when I was at Ontario Lottery and Gaming, and when projects get taken into a company, what generally happens is a business case will be written, and as part of that business case, the project has to be analyzed, right? And there's a whole bunch of different ways we can analyze projects. Now, this is on the finance side, right? Because as this class, corporate finance. But so specifically in this case, I'm going to walk you through all the different ways we would look at a project and we might do analysis on it, right? From NPV to what's the IRR. I even do this here at the university as well. So the whole point of this is that you can take multiple projects and from a numerical basis, you can compare them side by side and then make an educated decision on what is the best project to pick per se. So there are multiple methods which we'll get into, and then we're going to talk a little bit about some business practices in Canada, special applications of cash flow, and the optimal capital budget as well. So I'm assuming everyone has probably seen this by now. This is basically how we, very simply, how we value a business, right? And it's just the present value of all future cash flows. Now, funny enough, especially when it comes to the net present value calculation, which I'll show you, it's the same thing with projects. I know there was a bit of a pause in this class, but if you remember from Chapter 8 and how we value stocks, especially non-constant growth, a stock's just the present value of all future cash flows, right? So when we do a lot of these methods, it is focused specifically on future cash flows and analyzing those future cash flows, kind of putting a performance metric to it, and then we can do that for multiple projects and compare them side by side. So an overview of the capital budgeting process. It's basically a process to plan and manage capital expenditures, capital budgets for long-lived assets. So it's analysis of potential projects, long-term decisions are involves usually large dollar commitments, and it's critical to a firm's value. In most cases, depending on the company you work for, it's not an infinite amount of cash flow that you have, right? So usually there is a full, dollar budget for the firm, right? If I remember correctly, when I was at OLG, it was somewhere in the, ballpark of maybe $250 million. But you have a fixed pool of cash, right? And you have a whole bunch of different projects. I think in our case, there was around maybe 30, sometimes 50, it varied. But you have to go through and do this analysis and then determine, okay, based on the analyses, which projects have the best returns, the best future prospects, but also what's the cost? And then, with all the best projects included, how many of these projects can we do based on the dollars that we have available, right? So it's a lot more than just picking, what's necessarily the best project. You also have to consider there are dollar constraints and you can't invest in every single profitable project. So now a couple of the steps in the capital budgeting process. First, you have to generate ideas, proposals for projects, right? You have to come up with the projects, and then you have to estimate and assess the cash flows as well. So once we have an idea of what the project is, we make an assessment of the cash flow. We take all of the assessments that we've done for each individual project, and then we compare them against each other. And then that that drives our go, no-go decision on which project we will select. So categories of capital projects, there's replacements needed to continue profitable operations. Think of replacing a roof, right? This is by definition it can be a big project, right? But you're just replacing maybe either a large asset or whatnot, or in the case of a steel plant, if you have a large asset, you're just replacing it so that you continue your operations, right? And this is a type of capital project that you have to do analysis on. Maybe there's multiple different ways. Maybe you don't have to replace the whole thing. Maybe you only replace certain parts, right? Then there's also replacements to reduce costs, right? So not necessarily maintenance, but maybe we adopt a more efficient technology and that will reduce our costs. Well, what's the cost of that, right? And then what costs are we saving down the line, right? And we have to look at, is the initial cost worth the cost savings in the long run? And then expansion of existing products and markets, right? So we also have to consider, if we're going to expand into a new area, which we don't currently operate in, what is the growth potential for that market? And is it worth the initial cost of marketing, branding, developing products, right? And getting into those areas, and maybe all the people we have to hire as well to get connections in that industry too. And then expansion to new products and markets, basically same thing, right? One is existing and one is new. And then so there's also contraction decisions, safety and environmental projects. And then there's also mergers are also very, very large projects when you put, say, two businesses together as well. Maybe, or if you're buying a subsidiary, is it worth the cost? The initial investment, what are you going to get from that subsidiary? Is there any strategic advantages? So the first step in a project analysis is assuming that expected cash flows of projects S and L are given in a panel A, figure 10.1, and different evaluation methods are applied to calculate some evaluation measures showed in panel B. So high level, we're going to go through this project. I've also done this in Excel, so I will pull up my Excel document as well because I realize just looking off of this, it's not the easiest, whereas in Excel, I can kind of show you the formulas. So let's see here if I have the document already open. I believe I do. Yep, working doc. Okay, so it looks like everyone can see my screen, which is excellent. Okay, so it gives you two projects, and I'm just going to double check to make sure the numbers are lining up. 500, 400, 300, 100, 100, 400, 600. Yep, it looks like they are. Okay, excellent. So we'll open this up a little bit. You have two projects, right? First step when it comes to assessing a project is you always have to do a timeline. Well, why do we have to do a timeline, right? It comes down to money, right? Someone wants to join this call. Okay. So it comes down to the time value of money, right? $1 today is not worth, say, $1 5 years from now, right? If I asked you, would you rather I give you, say, I don't know, $1,000 or $1 million today, or would you prefer I give you, say, $1 million today versus $1 million 5 years from now? Of course, you're going to take the $1 million today. That is the right answer because you can invest that $1 million and you can earn interest over the next 5 years, therefore growing that $1 million, right? So $1 today is not worth the same as $1, say, 5 years from now. So in this case, we plot out a timeline so that we can assess, when we'll receive cash flows and when we're going to receive them, and then we can kind of assess the value of them. So in this case, we have project S here. It is a $1,000 upfront expense. I'm just trying to hunt out. There's my mouse. $1,000 upfront expense. A $500 cash flow in year 1, $400 in year 2, $300 in year 3, and $100 in year 4. And then project L, it's same $1,000 outflow in the beginning, but it's kind of flipped. So we only get $100 in year 1, $300 in year 2, $400 in year 4, and $400 in year 3 and $600 in year 4. So first we're going to do what's called a net present value. So if you remember back to maybe the first part of this course, when we did personal finance, and you think back to the time value of money and you think back to present valuing amounts, right? So when we do a net present value calculation, all we're doing is we're just taking all those future cash flows, right? And we're present valuing them to today's value at whatever applicable discount rate is, right? So in chapter 9, we talked about the weighted average cost of capital, and it was, say, the average cost of financing a project. So when we're assessing a project, we use the average cost to finance it, as a discount rate. By using that average cost to finance the project, we know that if our net present value is positive, the project is going to add value to the firm in today's dollars, right? If the project is negative, the returns will not exceed the cost of the project, and therefore we should not pursue it, okay? So when we're doing a net present value calculation, it looks a little something like this. Here's the formula. We just punch in NPV, And all we do is we tell the formula that our discount rate is up here at 10%, which you see in blue. And then we highlight from year 1 to year 4 all of our cash flows. So this is C6 to F6. Then you close the brackets, and then you just add on whatever the initial cash outflow is. The reason that you don't include this initial $1,000 cash flow in the net present value formula in Excel is simply because that the net present value formula present values future cash flows, and that $1,000 is already present value, right? So what's the present value of paying $1,000 today? It's $1,000, right? So therefore, within the formula, you don't include that 1,000, you just kind of add it on to the end, right? So all you're doing is you're present valuing all the future cash flows, and then you subtract off the initial cost. And then if it's positive, it provides value for the firm. If it's negative, the project provides no value for the firm, right? So in this case, we do our analysis, and we find that project S, and I'll scroll in a little bit here. So we find that project S has a present value of $78.82. So by making this $1,000 investment and buying into project S, and if it generates all those cash flows into the future, the value that this project provides in today's dollars is $78.82, okay? Now, when compared to Project L, based on the exact same calculation using the exact same discount rate, it comes out to a present value of $49.14. So what that means is Project L in today's dollars increases the value of the firm by $49.18, right? Now, it's tough being online because it takes longer to ask questions, but I'm going to ask a rhetorical question. Would you rather someone gave you $78.82 in today's dollars or $49.18 in today's dollars? Well, if you could pick both, you would probably pick both. Right? You would say, give me $78.82 and give me $49.18 as well, right? That's if we can invest in both projects, then we would just take both because they're both positive. They both provide positive value to the company today, right? Now, say you only have $1,000 to invest, right? It's not so simple anymore because I can't take both projects. I can only take one or the other. So in that case, you would say, okay, give me the 7882, aka I'm going to invest in project S, and I'm going to table project L. Maybe I wait till next year and I reassess project L, and maybe that's the more profitable project next year, right? But I do not have $2,000 to invest, so I'd have to pick project S because it increases the firm's value in today's dollars by the most. Okay. So we'll continue on. That is high level net present value and doing a timeline and how we assess those timelines, and plus a little bit of a refresher on the time value of money, which I hope is very helpful. So we will continue on with the slides, and I'm going to continuously pull this up. So there are 6 methods, right? So I just talked about the net present value. Then there's also the internal rate of return. There's the modified internal rate of return. There's the profitability index. There's the payback period, and then there's the discounted payback period. So that is a total of 6. Here is the cash flows for projects S&L, so exactly how I showed you, but I showed you it in Excel instead, just to show you kind of how the formulas work, and they both have that 10% discount rate. So this is the mathematical version, right? If you were, say, to write the formula by hand, but it's basically exactly what we did in Excel. So in this case, in Excel, right, we specified what the discount rate was, aka this is R. And then we specified all of our future cash flows. And then when we closed off the formula, the NPV formula, and we closed it, we just added on the cash flow today's debt, aka the initial investment, CF0, right? CF0 is the cash outflow today, right? And we don't need a present value because it's already in today's dollars. So this is exactly what we did, but we did it in Excel instead. And this is basically what a net present value is. So here is what it looks like more broken out, right? If we were to present value each individual cash flow. So for instance, $500 present valued at 1 year at a 10% discount rate is worth $454 today. $400 present valued 2 years at a 10% discount rate, aka our weighted average cost of capital, or aka our weighted average cost to finance the project, right, would be $330. Then $300 present valued over 3 years at a 10% discount rate will be $225, and so on with $100. You add up all those future cash flows together, right? And then you subtract that initial cash outflow, and that's how we get that $78.82 that we saw in the Excel, right? So it's just you have to put every single cash flow at the exact same time period, because cash flows at different time periods are not worth the same. But when we bring them to the same date, we can evaluate them all together, and then we can come up with, okay, what is this project worth today? And that's the whole point of an NPV. So I believe on the next slide, this is what it would look like if you basically did it by hand, right? Which is not what you'll be doing. I pretty much allow for every single one of my exams my students to use Excel, because I think it's really important that you're able to use these NPV formulas, because when you get into the real world and someone asks you, hey, and this happened to me not even 2 weeks ago, I was asked to vet a net present value. Instead of present valuing each individual cash flow, you'll just type in NPV, specify what your discount rate is, and then just highlight all the future cash flows, right? Starting with year one, going as far as you want. And it is by far the most efficient method once you get into the business world. But understanding the mathematics behind it is important, right? And this is what the mathematics behind it is. And it's present valuing each individual cash flow and then adding on the today's cash flow. I feel like I'm cutting myself off here. Okay. And then the spreadsheet solution is what I showed you, using the NPV formula, specifying the rate, and then applying the date range, and then adding on CF0, which is the initial cash outflow. And then rationale for the NPV method. So the net present value is the present value of all inflows minus the initial cost. This is the net gain in wealth in dollar terms. So if you want to accept the project if the project is above zero, that means it provides positive value to the firm. Now, if the NPV is, say, negative $50, that means investing in this project, in relation to the cash flows it generates, it would say actually it would lose value if it's a negative, right? So you might be generating, say, 9.5% return, but it's going to cost you 10%. So the firm's technically shrinking, because you're paying out dividends and you're paying out interest and all these different things to finance that initial investment in the project, but the project doesn't return those cash flows, right? So inherently, when you finance the project, but then you select a project that doesn't cover the financing, the value of the firm shrinks. How much does it shrink? Well, if the net present value is negative, by that amount, right? And then when you're dealing with mutually exclusive projects on the basis of a higher NPV, because it adds the most value, right? So when we say mutually exclusive, what we mean are separate, right? Think of a Venn diagram, but that does not touch. You can only pick A or B, right? So if you could only pick one of two projects, you pick the one with the higher NPV, right? And then you might reevaluate the one with the lower NPV at a later date, but the whole fiduciary duty of working in a corporation is that you need to maximize shareholder value. That's kind of the whole reason a company exists. Now, I realize it can be argued that outside of a finance perspective, that is a little bit overly simplistic, and specifically only considering that can lead to some issues, right? But at a very high level, our goal is to maximize shareholder value, and in order to be able to do that, we have to select projects that are going to maximize the value of the firm. Okay. So projects, independent or mutually exclusive. Projects are independent if the cash flows of one are unaffected by the acceptance of the other. Projects stand on their own. Both can be accepted for a positive NPV, right? But mutually exclusive, so that one project is accepted for a higher NPV, the other must be rejected, right? So independent means we could pick both, but mutually exclusive, like I just described, we can only pick one or the other. We can't pick both. The circles don't cross, okay? So project S and L, accept or reject. So if project S and project L are mutually exclusive, you would accept S, because as I showed you, project S has that $72 net present value, and I believe the other one was $42. Therefore, project S increases the value of the firm in today's dollars by $72, as opposed to project L that only increases the value of the firm by, say, 40, 42, 40, I can't remember what it was, right? But you pick the higher one. And then if they're independent, right, it's not picking one or the other, right? You're just individually analyzing the projects, and say you have $2,000, you can invest in both. They're both positive, you just invest in both of them. So now we're going to deal with what we call internal rate of return, okay? Now, I'm sure we all know the concept of rate of return, because when we covered in chapter 3, we talked about return on equity. We talked about return on asset, right? So what returns are, or sorry, a rate of return is, it's basically is what is my percentage, annualized return in relation to what my initial investment is, right? So in order to know what my rate of return is, I have to factor in my initial investment. Now, when we deal with internal rate of return, we completely block out all external factors. We don't pay attention to weighted average cost of capital. We don't pay attention to any of that. We only look specifically at the project. We say, what is my initial investment? What are all of my cash inflows over the next, whatever period of the project? And therefore, what is my annual rate of return, my compounded annual rate of return on this project, right? So if I gave you this project and I said, is this a good project? Is it not a good project? And you came back and you could say, hey, it's going to be a 12% rate of return. Weighted average cost of capital is 10%, right? So therefore, it exceeds our cost by 2%. Therefore, it's going to provide value to the firm, right? So I'm going to see, this is, again, the math behind it. So what we're doing is it's really, you set your NPV to 0. And when your net present value is 0, that weighted average cost capital rate, whatever it is that sets the NPV to 0, that's your internal rate of return. Now I'll show you that's a complicated way to say it, but I'll show you what that looks like on a graph, and it'll make a lot more sense. But mathematically, that's what it is. The internal rate of return is basically the rate that would set the project's net present value equal to 0. Okay. So 3 methods are used to find IRR. There's trial and error, which let's not do that. No one has time for that in today's world, right? Calculator solution. So a lot of times, there is the rate formula, but when you have non-constant cash flows, not a good thing. It's not going to fit very well for you. Now there is the Excel solution. Specifically the IRR formula. And this is by far one of the most effective ways. So I'm not sure if the previous professor had you buy a financial calculator or not, but if you do have a financial calculator, what you can do is you can plug in the individual cash flows of the project, plug in your initial investment, press IRR, and it'll spit out the solution. I bought a financial calculator for my finance course. I have not used it since because we have Excel and it's so fast. So I'm going to primarily focus on the Excel method of doing this. So what this looks like, right? If we remember back to when we did the NPV, with the net present value calculation, we present valued all future cash flows, but we used the weighted average cost of capital. Whereas in this case, we're not using the weighted average cost of capital, okay? We are present valuing every single cash flow for the project, and we're going to use the rate of return. That basically means that PV1, PV2, PV3, PV4 adds up to $1,000. Our initial cost is $1,000, right? So present value cash flow is 1,000, initial cost is 1,000, NPV is therefore 0. That rate is our internal rate of return. It's the compound annual rate of return on the project, okay? In this case, if we do it in a financial calculator and then press IRR, what you'll get for project S is 14.5%. And for project L, you'll get 11.8%, which makes sense. Both projects were positive. They both had positive NPV, right? Specifically with project S, it was a NPV of, I believe, I need to actually write these down. So for this, so I can be able to, I'm just going to hop back a little bit and I'm going to pull the NPVs of the projects. So perfect. We have NPV of project S, and I'm really hoping everyone can see this. So we'll have, yep, you should be able to. Project S, oh, you can't see that because the, it's dry. Okay, let's hope this one works. Oh, there we go. Okay, so project S and project L. Okay, so let's look at the profiles of the projects. Okay, so for project S, we had 78.82. And for project L, we had 49.18. Okay, so now I can stop guessing. Probably throwing you off. Okay, and then, so that was the net present value. We said, okay, excellent. Project S has the higher net present value. It provides more value in today's dollars, okay? So therefore, project S is better. If they're independent, we'd pick both, right? But if they're mutually exclusive, we can only pick one. We'd pick the higher one, okay? And then, continuing on, so then we did IRR, and when we did IRR, project S, I feel like this actually might be a little easier for you to see, so I might do this in blue. So IRR, project S had an internal rate of return of 14.5%, and project L had an internal rate of return of 11.8%. Okay, so in this case, right, when it comes to rates of return, you're going to want the project that has the highest rate of return, right? Especially if they're mutually exclusive and you can only pick one. Now it makes sense that project S has the higher internal rate of return because project S also has the higher NPV, right? So the general rule here is if, say I have my weighted average cost of capital over here, right? My weighted average cost of capital is 10%. So if I have a weighted average cost of capital of 10%, okay, and my IRR is higher than that 10%, that means my net present value is going to be positive because my rate of return exceeds my cost of financing the project. So the difference between here and here is the amount that increases the value of the firm. So if your IRR is higher than your weighted average cost of capital, your net present value is going to be positive. And this works for both because my IRR, even though it's lower for project L, it's still above the 10% cost to finance the project, right? So therefore, this one is also still a positive NPV, but this one is better because it has a higher value in today's dollars. Okay. And then this is using the, if you're using a financial calculator and you punch in all your cash flows, this is how you could find IRRs. But this only works if your cash flows are constant, right? If your cash flows are not constant, you have to individually punch in every single cash flow into your financial calculator. And that's where things get really tough, okay? That's why, in practice, we don't really use financial calculators. What we use is we use Excel. Because in the same breath when we do our analysis, let's look at this here. In the same breath when we do our analysis, what we can do is I already laid out this entire timeline for my net present value calculation. Now I just do equals IRR, right? And I just highlight including year zero, okay? In the net present value formula, we did not include year zero, and this one we do, okay? So we include year zero, we just highlight all the cells on the timeline, and then bang, we get the 14.5% rate of return. And then we do the exact same thing for project L, and we get the 11.8% rate of return. So you can do this at a financial calculator, or if you set up your timeline well, and you always start with year zero when you highlight your cells, you would literally just punch in, and I'll do it live as well to show you, IRR, select, and then you just select all your values, enter, boom. And this is 11.8. It's just rounding, so let me prove that, and it works. That's all it takes. finance doesn't have to be hard. And luckily, with advancements, right, and everything available to people in Excel, you no longer have to be, necessarily excellent in math to be able to be a finance professional. Not at all, actually. If you can understand high level what's going on here, and you understand that your rate of return has to be higher than your cost, now you can evaluate the rate of return all across all your projects. You don't have to be really good at algebra to calculate, the rates of return. You just have to know how to set up an Excel. Okay, so that's why I tend to lean heavier on the Excel side when I teach this stuff. I do hope that makes sense. I'm very much usually an in-person teacher, and I like to be able to judge everyone's comprehension, but it's tough when I'm staring at blank screens. So I appreciate everyone bearing with me. I hope some of you at least find this somewhat interesting. So we'll jump back into the lecture. Okay. And then that was the spreadsheet solution. You just go =, IRR, fill out the data range, and you're good to go. Okay, so rationale for the IRR method. So exactly as I just explained, right? If your IRR is higher than your cost of capital, you're gonna have a positive net present value. You accept the project because your return is greater than your cost, right? It's the same thing as investing on the stock market. If you say you pay an investment manager, I don't know, 2%, 3% fees, but they get you 11% return, you're in the money, right? But if you pay them 2%, or say you pay them 3% fees, but they only earn you 1% in income, you're at 2% loss, right? It's the same deal. Just now, in this case, we're analyzing projects, okay? It's a very easy way to very quickly analyze the profitability of projects, right? And compare it to the weighted average cost of capital. We call it internal rate of return because we don't factor in the weighted average cost of capital, right? So we're saying it's internal, right? Because we don't touch external factors when we calculate IRR, okay? And this is important to remember because when we do MIRR, we do factor in external factors, right? And that's why we call it modified. But we'll get into that next. So if you're doing, evaluating project S&L purely on IRR, well, here's the thing, right? Both of these, as I stated, are higher than the cost, right? Return is higher than the cost. That's a good project. Sure, accept it. Return is higher than the cost. Excellent. That's a good project. Accept it. Say we don't have $2,000, we only have $1,000 to invest. You pick the one with the higher IRR that is greater than your weighted average cost of capital, which is just your weighted average cost to finance the project. If anyone needs a quick refresher on what weighted average cost of capital is, just think about it like this, right? I'm sure at least every single person in this call has had to calculate their grade before, right? And they had to use the individual weights of their grade. So say your final exams were 35%, your midterms were 30%, right? What you do is you take that weighting of, say, the final, and then you multiply by what you got on it. And then you take the weighting in the midterm, and then you multiply by the grade, right? It's the exact same thing, but with weighted average cost of capital, all you're doing is you're taking the cost of that financing source and multiplying it by the target weight, right? When you put it all together, it's the combined cost to finance the project all in one number. Not, oh, my common shares, I'm going to issue 50 million of them, it's going to cost me 9%, and then my long-term debt's going to cost me 6%, but then I get a tax deduction on it. And then, oh, don't forget about the short-term debt as well. And I also get a tax. No, all in one number. What is the cost to finance the project? Not the individual components, all in one combined based on my capital structure, right? That's weighted average cost of capital, and that's why it's important because it tells me what's the cost to finance this project. Okay. And then, so we'll move on. So comparisons of the NPV and IRR methods. So NPV rankings depend on the cost of capital, evaluating independent projects, and then evaluating mutually exclusive projects as well. So here are the, this is what's called an NPV profile. So it's when you enter in the cash flows in the calculator and find the NPV. And then you find the NPVs at different discount rates, right? So if my discount rate is 0, I'm not discounting my cash flows at all. That's easy, right? I just add them all up together, right? And then subtract off the initial, right? But say, maybe what's my discount rate at a weighted average cost of capital, right? Sorry, what's my NPV at, say, a discount rate of, say, 5%? What's my NPV at a discount rate of 10%? What's my NPV at discount rate of 15%, right? What you're going to notice is as your discount rates get higher, the cash flows further out are worth less, right? Because we're discounting them more at a higher rate, right? So at high discount rates, you'll favor projects that have decent initial cash flows, right? But at low discount rates, you're going to pick projects with really good long-term cash flows, right? That just have overall greater cash flows as opposed to immediate return. And I'll show you exactly how this works. Okay, so this is the net present value profiles of the two projects. I believe I actually did this in Excel myself. I'm hoping that maybe if I show you my work, it might make a little more sense than staring at this. Lecture working document, excellent. Okay, let's see. There we go. Mine's a little less drastic. I didn't push the axis in, so it's a much more gradual line, but it still applies, right? So this is me calculating the net present value of, say, project S at a 0% weighted average cost of capital, right? All this is just, adding these all together. I go down to here, and my sum is $300. There's no discount rate, so all cash flows are equal. Doesn't matter what time they're at, right? So this one's worth $300, and then these all put together, I sum them down here in the corner. It's worth $400. So therefore, my weighted average cost of capital is 0%. My present value of project S is $300. Present value of project L is $400. But interestingly, as my discount rates increase, right? Of course, the present values are less because now I'm, reducing the value of the cash flows, right? So at 5%, project S would be worth $180 in today's dollars, whereas project L would be worth $207 in today's dollars, right? So at 0%, I'm going to pick project L, guaranteed, because it has the higher net present value. At 5%, I'm going to pick project L as well, right? Because $207 is better than $180, and this is assuming that the projects are mutually exclusive. However, now you see it jumps up to 10%. Okay, all of a sudden, project S has a higher net present value than project L, right? And what's happening here is project L has cash flows much further out. But overall, project L has $400 in total cash flows, whereas project S has $300 in total cash flows, right? So as I increased my discount rate, this project became worth less and less and less because this cash flow way out in year 4, it keeps getting discounted at a higher rate when I increase my discount rate, right? So in this case, what happens is now project S has now basically surpassed project L. So at some point between the discount rate of 5% and 10%, my decision point changed, right? Project S became more attractive than project L. And what we call that is our crossover rate. So if we look at this graph right here, and I'll zoom in. Whoops, sorry about that. So I'll zoom into the graph, and this is just, I plotted it out. What happens here is the orange line is project L, and we can see, this is at 0 up here, and then this is also at 0% discount rate. So obviously, as the discount rates increase, the valuations of the projects drop, okay? Now, project L decreases at a faster rate because it has those further out cash flows that are more susceptible to discounting. Whereas project L decreases at a slower rate, the value of the project decreases at a slower rate because it's more front loaded with the cash flows and it takes a higher discount rate to reduce their value, right? So right about here, it looks like this is the exact point where the values of the project costs, and at that exact discount rate, the value of the two projects is equal, right? And that is our crossover rate. We very simply can calculate this crossover rate over here at 7.2%. It's just the internal rate of return of the differences in the cash flows, but I'll show you that a little bit later. But anyways, it's 7.2%, right? And at a 7.2% discount rate, this is when project S becomes more attractive than project L. So after 7.2, you're picking project S. Before 7.2, you're picking project L. And right at 7.2, the projects are basically they're worth the exact same, right? You're not picking either one. You don't care. You pick one or the other. It doesn't make a difference. But this is important to understand because this is where we get into the concept of hurdle rates, right? You set a rate for the firm, whether it be 12%, 10%, 5%, right? And you have to understand that the rate that you pick to discount your projects will drive the projects that you pick, right? If you pick a high discount rate, you're not going to pick projects that have, big long-term cash flows. You're going to pick the safe projects with short-term high cash flows. But if you choose a smaller discount rate, right, you're going to favor the big projects with big long-term cash flows, and you may shy away from projects that are shorter, that have, decent initial cash flows, but overall don't have, the volume of cash flows that the bigger projects have, right? So you have to understand, at that crossover rate, that's your decision point, and that's where your decision would change when you're selecting projects. And that's why it's important. Okay, so we'll hop back into the lecture. But before I do, you may remember that I told you that the internal rate of return is when we basically present value the future cash flows at a rate, whereas my net present value is equal to 0. I will prove that to you now. If I look at this graph over here, what you'll see is for project S, this line keeps dropping, keeps dropping, and over here on the left side is the net present value of the project. So in theory, when the net present value of the project is 0, I should get my internal rate of return, and I do. So where project S crosses the x-axis here, this is actually rate at 14.5%. And that is my internal rate of return, as I stated up here, right? So this therefore proves my internal rate of return, right, it occurs exactly when the net present value of my project is equal to 0, okay? Same thing with project L. When project L comes all the way down and then it finally crosses the x-axis, right, and the project's worth 0, that crossing point, that percentage, is the 11.8% internal rate of return. When my NPV is equal to 0, that is my compound rate of return, okay? Okay, so I'm throwing a whole bunch of numbers at you. This, if you want to look at this after, this also perfectly explains everything that I just did, but I gave you the numbers and kind of the math behind it as well. So the 7.2 crossover rate, and then the individual crossing rates of the x-axis, those are your internal rates of return, right? And then how the values of the projects drop and how they cross over time, depending on the discount rates that you pick. Okay, I'm asking so many, or I'm giving you so much right now. Is there any questions, anything you're unsure about? I'm gonna pause for just 2 seconds if you want to ask anything about, anything we've discussed thus far. Because these are the two bigger methods, and then we're gonna get into some other ones. But these ones really piggyback on each other. No? Okay, I'm really hoping that silence equals agreement on here and everyone's following, because I do know from teaching this in person that it can be tough. Okay, if you do feel a little bit lost, don't worry, this is recorded. You can always send me an email after this. I'm happy to explain it. It is all good. Okay, so NPV rankings depend on the cost of capital, right? Okay, this is everything I've already explained, right? Your crossover rate is 7.2%. If your cost of capital is less than 7.2%, you're picking project L. If your cost of capital is higher, aka your discount rate is higher than 7.2%, you're going to pick project S, right? Because it's the point where your, where your project selection will change, right? And the project with cash flows further out will have a steeper curve as the weighted average cost of capital increases. Okay, so evaluating independent projects are evaluated separately, and there is no conflict between the NPVs. Therefore, you don't care about the crossover rate, right? It doesn't make any sense because there isn't a point where it would change my decision. All I care about is that the value of my project is positive. So if I'm not comparing two projects and where they cross, but I'm instead comparing one project, well, how I would read this graph is right here, my IRR. If my discount rate is higher than my IRR, the value of the project is going to be negative, right? But if my discount rate, aka my weighted average cost of capital, is lower than my IRR, the value of my project is going to be positive, right? So if I'm just simply evaluating individual projects, calculate your IRR. You take that number. If you pick a hurdle rate that's higher than your IRR, your valuation is going to be negative. But if you pick a hurdle rate that's lower than your IRR, your valuation is going to be positive. So very, very simply, right? Say you do internal rate of return for all of the projects that you have them ranging from 12% rate of return, 10, 8, 6, right? You set a hurdle rate of 9%. Any project that's under 9% rate of return, you're not going to pick, right? But any project over a 9% rate of return, you're going to pick because you're going to be profitable. That's without all the mathematics and the complications. That's all it is, right? If your returns exceed your cost, you'd pick it. That's all this is. It's nothing more than that, honestly, once you get down to it. Okay, and then evaluating mutually exclusive projects. So when it comes to mutually exclusive projects, that's when we care about the crossover rate, because that's when our decision changes, aka rate at this point right here. So at the 7.2%, if I pick a discount rate that's higher than 7.2%, I'm going to pick project S, because project S is worth more than project L. But if I pick a discount rate that's less than 7.2%, I'm going to pick project L because it has a higher net present value than project S, right? So at that 7.2%, that's the point where my decision would change, and that's why the crossover rate is important. Okay, so to find the crossover rate, all you do is you line up the two cash flows of the projects, you take the differences in the cash flows between the projects, and then you use that internal rate of return formula that I showed you, highlight all the cells, and then it'll spit out the crossover rate, aka the point where the two lines will cross. So I did show you it, but I'll pull it up quickly again to show you how that works. So here's my working document for this lecture. We'll hop back over. Okay, so just like I said, I take the differences. So for instance, in year one, Project S's cash flows are $400 higher than Project L's cash flows. In year two, Project S's cash flows are $100 higher. Year three, Project L's cash flows are $100 higher. In year four, Project L's cash flows are $500 higher. So you have one that's kind of front-loaded versus one that's end-loaded, right? I take all of those differences. I go down in here. I basically just goes equals IRR, internal rate of return. Double click, and then I just highlight my values going down, starting from the top, going down. It spits out my crossover rate of 7.2%. That crossover rate is very simply just where the two lines cross, your point of decision between two projects. Okay. Okay. I must admit, teaching online lectures is a little harder because it's just I'm just constantly talking. I don't get to ask questions or put some of the talking pressure on you. It's just purely me. But I'll get used to it. Okay. Now, 7.2. Okay. And yes. So this is for the payback methods. So we'll get into payback methods in a little later. But that is the whole idea behind crossover rate, IRR, and also the conditions for crossing NPVs. Now, here's the thing: the crossover rate only works if you have one project that say is front loaded with cash flows and another one that's more end loaded with cash flows, because those two projects are going to cross, right? However, if you just have both projects that just have uniform cash flows, it's just going to look like this. The lines will never cross, right? So you'll never have that crossover rate, right? Whereas when one has those end-loaded cash flows and the other one is front-loaded, one's going to be worth more at the start and one's going to be worth more at the end, which is what we saw there, right? So in this case, if you want to do crossover rate, you need two projects that have significantly different cash flows and timing and cash flows as well, right? And then you'll see a crossover rate. Whereas if you pick two projects, one pays out $500, right, every single year. One pays $1,000 every single year for the exact same number of years. It's just going to look like this. And especially if the initial cost is the same, they'll never cross, right? The lines will just be parallel. So the crossover rate won't apply. And that's all that slide means. Okay. Now, we're going to talk a little bit about reinvestment rate assumptions. So the NPV assumes reinvesting at R, right? Which is the opportunity cost, aka your weighted average cost of capital, aka your cost to finance the project, okay? Here's the key difference. Internal rate of return, we call it internal because it doesn't factor any external rates. It's only within the firm when we talk about internal rate of return, okay? So with internal rate of return, it assumes that you're also, say if you have a project that's 14.5%, so those cash flows that you get on this project, right? I believe there was like a $500 cash inflow, say at year one. And so what this assumes is that all future cash flows are reinvested at that same 14.5%. Now, that's not necessarily true, right? Because for you to be able to reinvest those future cash flows at 14.5%, what has to happen is you have to have another project lined up that also generates a return of 14.5%. So therefore, the returns are slightly actually overstated, right? If we think about this. Now, with our net present value, it doesn't assume that we're reinvesting at 14.5. It assumes that all future cash flows, right, they will be reinvested at the weighted average cost of capital at 10%, okay? So we have this thing, and it's a hybrid. It's a hybrid between the two. And it's called modified internal rate of return. And for modified internal rate of return, it's like internal rate of return, but instead of assuming that you're reinvesting at the rate of return of the project, you can actually tell the formula, okay, regardless of whatever my rate of return is on this project, I'm still going to reinvest my future cash flows at, say, my weighted average cost of capital, right? And what it will do is it'll future value all those cash flows at a different rate. And then it will bring down the rate of return of the project, but it's more accurate because it doesn't assume that, say, on a 14.5% project, you're going to reinvest all those cash flows into another 14.5% return project, right? But I'll show you a little more of the math behind that, and it should make more sense. That's high level what it is, though. Okay. You can also have the circumstance where you get multiple IRRs, and it's when you kind of have a curved, it's a curved NPV profile where it comes up, it crosses the x-axis, it's profitable, and then it drops back down, right? And then it's in very specific circumstances, but it is a little more complex. And a modified internal rate of return, you won't have that situation. It's completely avoided. All right. So normal versus non-normal cash flows. When you have normal cash flows, what you have is you have an initial cash outflow, and then you have positive cash inflows, right? So if we're talking about like this, so this is year 0, this is year 1, year 2, year 3, right, and so on, right? A normal cash flow will just be an initial cash outflow, say of, let's fill in some numbers here for fun. $100, right? And so you'll have 50 bucks, 40 bucks, 50 bucks, right? This is normal. Whereas you may have an abnormal cash flow, right? In an abnormal cash flow, what you'll have is, say, year 0, right? Year 1, year 2, year 3, and so on. What's going to happen is, yes, you'll have, maybe your initial cash outflow, and then say, oh, I'm going to earn, maybe $70, and then earn another $50, and then in year 3, it doesn't erase very well, and then year 3, all of a sudden you have a $60 cash outflow. So when you have an abnormal project, right, all of a sudden, in some circumstances, you're going to run into the issue where you have also a cash outflow in the future, and that cash outflow is also getting discounted as well, and it's going to be worth less at higher discount rates. That ends up, inherently curving your NPV profile, and you can end up with two internal rates of return in that circumstance. So when you have that type of project that's abnormal and it has cash outflows into the future, which is common, so you have to retire an oil rig, right? Or return an environmental property that you own back to its original state. That's a future cash outflow you have to incur, and you have to factor that into the project, right? Because it's a result of taking on the project. So these do happen, and you have to recognize them, and you have to recognize that sometimes your IRR might be misleading, especially in these cases, and you might have two IRRs. Okay, So this is the cash flow patterns, right? Whereas, what we're saying here is, where'd my mouse go? Still hidden. Oh, there we go. So negative outflow, positive inflows, normal cash flow. Negative outflow, positive inflows, and then negative end outflow, abnormal cash flow, not normal, right? And then negative, 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 positive, positive. They still consider this normal. You won't have two internal rates of return, right? If you have positive, 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 negative, 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 it would still be considered normal. But the second you interchange positive and negative, it becomes abnormal. What do they actually call it? Or non-normal. Okay. So here's project M. We have what's the NPV and what's the IRR? So we have a rate of return of 10%. Well, sorry, a weighted average cost of capital, we might say of 10%. That's likely what that is. And then we're going to pay $1.6 million today. Then we're subsequently, after, we're going to receive $10 million in year one. And you might think, wow, that's pretty good. $1.6 million today, and then I'm going to receive 10 mil. Awesome. Okay, but in year two, you're going to have to pay out that, another 10 mil. So is this project good? Is it not? Hard to say. So we do our NPV, and we can do this in Excel. So if we did the NPV on this project at that 10% rate, what we would get is 0.77 million negative. Okay, so this would generate negative value for the firm to the tune of about $774,000. Okay, if I did an internal rate of return though, my IRR is 25%. So you're going to say, well, hold on, you lied to me, right? In this case, my IRR is higher than my discount rate. I have an IRR of 25% and I have a discount rate of 10%, right? My net present value has to be positive, right? Why is it not positive? It's because it's an abnormal cash flow. It's because we have a massive cash outflow and it's screwing up the IRR calculation, right? So if you only did IRR and you said, hey, rate of return 25%, cost only 10%, that's like a 15% excess. I'm taking this project. And then 2 years later, you're like, wow, my firm's value shrunk by $774,000. What happened? It was an abnormal cash flow and you had two IRRs screwing it up. Okay, so what this looks like is when it spits out an IRR of 25%, it is giving you where it crosses the x-axis, and yes, technically your NPV is 0, but the problem is your NPV was negative before it crossed the x-axis. So your NPV is negative, 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 and then it becomes positive at 25%. And then it accelerates upwards, and the higher the discount rate, right? It's like almost like peak at 125%, right? Discount rate is when our project's worth the most. It's worth almost what, $700,000, $800,000 at that point. And then as we keep cranking up the discount rate all the way to 400%, then it's finally the net present value drops back down to 0, right? And what's happening is in this previous slide, right? As we crank up the net present value, this future outflow is worth less and less, and it's getting discounted faster than this inflow, right? Because this gets discounted twice, right? Whereas this inflow only gets discounted once. So at some point, if I increase my my discount rate enough, this 10 million here is going to be worth more than this 10 million outflow and this initial 1.6, right? Just by mathematics, right? And if I keep cranking it up, it's gonna that trend's gonna increase until I discount these so much that they're worth so little that they're not even worth the 1.6 mil anymore. And then that's when we hit 400%. So that's what's happening here. We have two IRRs because it's an abnormal cash flow, aka 2x intercepts, because we have a huge outflow at the end. We have our initial outflow, and then we have an inflow in the middle, right? And it's throwing out the calculation. So we have to be aware of this so that we don't make a rash decision and we tell someone, hey, I have a great internal rate of return. Let's invest in this project, right? And then we find out, oh, no, maybe we shouldn't have done that. All right, so use NPVs instead of IRR. So with two IRRs, NPV is negative between 0 and the first IRR, but positive between the two IRRs, and negative again beyond the second one. So the NPV criterion is straightforward. If the cost of capital is 10%, its NPV is going to be negative, right? As the cost of capital increases, though, technically our NPV will be slowly. It'll have less of a negative impact, as we use a higher cost of capital, and eventually when we, exceed 25%, the NPV will be positive. But in this case, right, the IRR would mislead us. We would say cost 10%, IRR 25%, except the project, right? Whereas if we did the NPV at 10%, it would be negative. It would be that $774,000 loss, right? It wouldn't mislead us. So in this case, the NPV is, it's more truthful than the IRR calculation is. So why use MIRR versus IRR? Well, in addition to the NPV, MIRR also avoids the problem of multiple IRRs because we don't assume that it's reinvested at the internal rate of return. We state that the rate that the cash inflows in the future are reinvested. So MIRR correctly assumes reinvestment at the opportunity cost, which is our weighted average cost of capital. Okay, so managers like using rates of return for comparisons, and MIRR is better for this than IRR. It's more truthful and it's more accurate because we're not assuming we're, say, reinvesting at 14.5%. We're assuming that, say, that initial $500 cash flow, or even that $10 million year one cash flow, it's not being reinvested at 25%. No, it's being reinvested at 10%, right? And that's what we do. In these projects, when we earn cash flows, we don't just over a 10-year project, we're earning $500,000. You don't just keep the $500,000 and throw it into a bank account and leave it all there to the end of the project. No. The second a firm has excess cash flow come in, finance professionals are looking for ways to use that liquidity to invest in more projects, right? And then by doing that, you basically exponentially multiply the value of your firm, right? Because you're financing, other projects with the cash inflows of previous projects, and that overall exponentially increases the value of the firm. Okay, so continuing on, I've been talking for an hour straight. I'm not used to this. You don't have to do this in person. All right. So modified internal rate of return is the discount rate that causes the PV of a project's terminal value to equal the PV of the cost. Then you're probably thinking, what's the terminal value? I got you covered. I actually have a working paper on this that I'll release, and it'll show you exactly what's going on. But I think the slides make an attempt, but I'll show you the actual math behind it as well for anyone who's a math geek like me. I'm an accountant. So terminal value is found by compounding inflows at the weighted average cost of capital. So what you do is you take all your cash inflows and you future value, right? So if I were to, oh no, there isn't a good board eraser in here. That is problematic. Okay. This looks like a blackboard eraser. Oh no. Oh, maybe. It's not too bad. Oh, jeez. It's leaving black marks. Wow. I really hope Physical Plant never watches this video. Oh. Okay. Guess that's good enough. Hey. Hold on. Quick little, if anyone wants to grab a little tea, it's going to take me about 1 minute. Look at that. Oh, that's still not coming off. Really sharply. Wow. The problem is all my colleagues know I teach finance, so if they come in here in the morning, there's a scribbled out timeline, they're gonna notice me. So I have to, can't be leaving a mess here. All right, that's good enough. So back to what I was talking about. When we're doing MIRR, I'm not using red again. That was a mess. So when we're doing MIR, what a disaster. Oh yeah, this is the dry marker. Try this one. So when we're doing MIR, we'll draw our cash flow or a timeline, right? So what happens is when I have, so this is say time 0, this is time 1, this is time 2, 3, and 4. So my positive cash flows that I received during this project, they're brought forward to this point in time, okay? So say I have a, I don't know, a cash flow of 50 bucks here, right? And then I have a cash outflow of negative 40 here. And then I have another 50 bucks here, right? And then I have, I don't know, 80 bucks here, and then I have a negative 100 bucks here. Sorry, I'm making this all up, but the principle is still important. So with MIRR, what MIRR does is we tell it, okay, this is my the rate of return I'll get on these cash flows when I receive them, right? So it will be, say, reinvested 10%, right? So what MIR is going to do is it's going to take this 80 bucks, this 50 bucks, and then the 50 as well, and it's going to future value them at this 10%, and it's going to add them all up, and the future value of all my cash inflows, right, at my reinvestment rate, that is the terminal value of my project, is what we call it, okay? And then what MIR does is it present values all the cash outflows. So this $40 here, and I'll change colors, right? So this $40 here is going to be brought back, and then it's going to get added onto this $100 that's already present value. And it's going to come up with basically a total cost in today's dollars of the project, right? And what it's going to do is it's going to come up with this total cost, and it's going to compare it to the terminal value. It's going to bring the terminal value back to today's value to wipe this out, and that rate that it uses is your MIRR. And I'll show you how this works in Excel. But high level, that's what MIRR does, is it reinvests the cash inflows as they come in. It tells you what's the future value of all my cash inflows, compare it to the total cost of the project, and come up with the total rate of return based on those two numbers, okay? And high level, again, if your MIRR is higher than your weighted average cost of capital, you're accepting the project because it's applying value, so long as there are not other more profitable, mutually exclusive projects that you should be picking, okay? So here's what this looks like in Excel, in Excel on the slides. I'll show you Excel. It's basically, it's reinvesting the cash flows. In this, it's reinvesting the 10, it's reinvesting the 60, and it's doing it at this 10%, okay? So the terminal value of the project, and this is a new term specific to MIRR, aka the future value of all cash inflows, is $158, okay? Whereas the present value of all outflows is $100, right? This is already a present value, we don't need a present value, right? So I have a terminal value of $158 and then a present value of outflows of $100. So now what it does is it brings back the terminal value of the project back to the initial outflow to basically wipe it out, set the NPV equal to 0 is basically what it's doing, just like IRR does. But instead it's going to spit out a different rate, okay? It's going to spit out your MIRR because we're comparing terminal value to the initial cost, okay? So it's taking that $158, and it's present valuing it so that it's equal to $100 so that the net present value is 0, okay? And then, yeah, that gets us a 16.5% modified internal rate of return. This is how you would do it if you're using a finance calculator. You'd have to punch in your cash flows, and then you'd have to specify your basically what is your reinvestment rate, and then it would spit out what your MIRR is. It's a multiple step process to be able to do this in a finance calculator. It's much faster to do it in Excel. Yep, this is purely just to get it in a finance calculator. Okay, here's the MIRR for Project M. So say 1.6 million, right? Initial cost, 10 million or cash inflow in year 1, 10 million cash outflow in year 2. So if we present value the 1.6 million and we also have to present value the 10 million, right? We can't forget about this because this MIRR present values all cash outflows, not just day 1, okay? So it has to present value 1.6 million and it has to present value the 10 million as well, right? So the total cash outflows of the project at year 0 time is $9.86 million, and that's putting these two together, okay? And that's at this date. That's basically that's the present value of the cost of the project, right? Whereas now MIR is going to bring this 10 million, and it's going to bring it forward to year 2 to get the terminal value. So it's going to future value at 10%, right? So basically, in today's dollars, the cost of this project is 9.86 million, and the future value of all the cash inflows that I'm going to receive is $11 million, okay? I bring back this $11 million to wipe out my $9.86 million cost. That rate that I bring it back at, that's my modified internal rate of return of 5.6%. Okay, so this is where I don't know. If you're kind of into Excel and into the finance stuff, you're going to find this cool. If not, you're probably going to find this boring. But I did build this. So, and this is specifically in relation to a problem in the textbook, which is fine because I'm using a slightly newer textbook, so this won't help you at all. So, this is a visual example of what MIRR is doing, but in Excel, okay? So I have a project here, and $400 initial cost, and then $528 cost in year 1, $219 in year 2, $150 outflow in year 3, okay? And then year 4, I finally get positive, and I finally have inflows. So I have inflows of $1,100, inflows of $820, inflows of $990, and then finally in year 7, I have another outflow. So what this is doing is I would future value all of my inflows, right? So this year 4 outflow, right? That is this outflow right here. So $1,100 future valued for 3 periods at 10%. I believe, yeah, weighted average cost of capital is 10% over here. So future valued would you would get that 1464. And then I would future value my year 5, right? And then so 820 earned at year 5 is worth 992 reinvested at year 7. And then lastly, the 990 earned in year 6, future valued for 1 year at a weighted average cost of capital is 10%, is worth $1,089 at year 7. So the total terminal value of this project is $3,545, okay? I then also present value all of my outflows. So all of these outflows are brought back to year 0. 528 paid in year 1 is worth 480 today. 219 paid in year 2 is worth 180 and 99 today, right? And then I also bring back this 325, which is worth 166 today. The present value of all my outflows here is $1,340. The future value of all my inflows is worth 3,584. So what I do is I set this so that this is my future value, this is my present value, right? There are no payments. And then I just solve for the rate. The rate of return on this to bring this back to equal this would be 14.91%. And that is modified internal rate of return, okay? Your head might be spinning a little bit right now, but I'm hoping that, if you take a step back, forget about the math, forget about all this, and you just think about this high level, IRR, say a project earns $500 in year 4, and the IRR is 14.5%, that project assumes that $500 is reinvested at 14.5%. Whereas MIRR, that same $500 earned at year 4, no, we don't assume it's reinvested at 14.5. We tell it it's reinvested at 10, okay? And that inherently reduces the rate of return on the project, okay? Because I earn a lesser rate of return on the inflows. So I hope, if you don't think about it too much, it makes a lot of sense. And I've noticed that. A lot of times when I'm explaining things in class, the more my students think about it, the more they get confused. But if I can get them to step away from their laptop and think about this on a broad level and how this impacts decisions, they can usually understand it. So I challenge you to take a step back from all this and just think about this high level, what this truly means if you're reading this back through, and put yourself in the position of a decision maker when you're doing this analysis. All right. So again, high level, MIRR, it's below your required rate of return or your weighted average cost of capital, you're not picking the project. Your return is less than your cost, don't pick it, right? If your MIRR is higher than your weighted average cost of capital, you pick it because your returns are higher than your costs, so you're good to go. In this case, my MIR was less than 10%, right? For that, I believe it was like 5.6%. And my NPV was negative, right? So therefore, it's very clear we do not pick this project. It's not. It's worth negative dollars today. I'll lose money on this project if I accept it, really. And then, so mutually exclusive projects. So we have MIR or NPV. So for two mutually exclusive projects of equal size and the same life, NPV and MIR will always lead to the same decision. The same can be said for projects of equal size but different lives. And then conflicts can also occur for projects of different sizes as well. NPV is pretty much the best in every single circumstance. It's pretty widely applicable. For projects of significantly varying length, we have an equivalent annual rate, or equivalent annual annuity, I believe it is, that we calculate. But anyways, we'll get to that later in this lecture. But for now, if you have a half-decent grip on what NPV, MIRR is, and IRR, you're in really good shape, okay? All right, so profitability index. This is the bang for buck calculation, is what it truly is, okay? What is the present value of all my future cash outflows, or sorry, what is the present value of all my future cash inflows, right? And then what's my initial cost? And it's just that present value divided by my initial cost. That's all it is. So for every dollar I'm paying today, how much is it returning is all it is. So in this case, and this is for Project S, the present value of all those future cash flows was $1,078, okay? The initial cost, if we remember, was $1,000, right? So if I take the total present value of all those cash flows and I divide it by initial cost, I'm basically making 8 cents for every dollar I've invested, and that's what this is, okay? So in this case, what I'm saying is, on this $1,000 that I'm investing, on every dollar I've invested, I'm basically you're basically making about 8%. I think 8 cents might have been a little misleading, but you get the point. So it would be $8. I don't know. I have to think about that one. Yeah, it would not be 8 cents. Don't quote me on that one. That was incorrect. But it's basically a bang for buck calculation. So what's the relationship between my cash flows and my initial investment? So if my cash flows are worth less than my initial investment, right? Well, then I'm going to have a profitability index that's less than 1, right? And then I wouldn't accept it. So in this case, Project S, my bang for buck calculation, I have a profitability index of 1.8. Well, maybe I did say it right. So on a present value basis, S is expected to produce a $1.08 for each dollar of investment, not 8 cents. So for every dollar I invest in this project, it's going to produce $1.08 in return. That's profitable, right? Because it's producing more than I'm expending, right? Whereas for Project L, the profitability index is if I invest $1, in today's dollars, it's returning $1.05. Still profitable, but Project S is the more profitable option, and therefore I picked that one. So that's all profitability index is. It's just what's the relationship between the present value of the future cash flows and the initial cost, right? And it's that relationship of how much cash flow does it generate for every dollar I invest. It's a good way of looking at it. Okay, so we've done NPV, we've done IRR, we've done MIR, we've done profitability index, right? If you remember correctly, that is a significant portion of the different project analysis methods. This is a big slideshow. I'm not going to kid you on this one. Usually I'll get through this slideshow and then I'll spend a whole nother class just doing problems, right? But fortunately we don't have that luxury, so I'm trying to really integrate my examples with my lecture as we go along here, right? So if you're feeling tired, that is okay. This is a lot of content, even for me, and I work with this stuff a lot. So, while NPV and IRR are the most widely used methods today, the earliest selection criteria were the payback methods, okay? And it'll be very easy to understand why. So, all a payback method is me saying, okay, I'm going to invest $1,000 today. When do I earn back that initial $1,000, right? You might say, oh, I'm not going to factor in the time value of money. It's going to take 3.4 years for you to earn back your initial investment. That's super easy to understand, right? As compared to internal rate of return, where it's like, oh, your compound annual return on this project is 16% and your cost is 13%, right? Is this a good project? Who knows? But if I tell you, hey, this project, you get your money back in 2 years. This project, you get your money back in 4 years. You're picking the project with 2 years, right? Because, hey, I get my money back really fast. It doesn't tell you anything after you get your money back, but it tells you how fast you get your money back, right? And that's why this one's good, and it used to be extremely popular. I believe back into the 70s and into the 80s. In the 80s is when, and don't quote me on any of this, but I believe that's when NPV really took off in popularity. But up until then, Payback Period was one of the most popular because, you know, to the average investor, you could very easily communicate what it meant. Now, calculating it, you have to do a timeline and you have to be half decent with Excel, but it's very easy to understand, and that's what I'm going for here. Is I'm going for comprehension over pure calculation. That's why they employ me, the accountants that work in the firms, right? We do these calculations, we give you the metrics, and then you can make your decisions, right? But if you can go through and you can understand what these different things mean, if you can understand what NPV means, if you can understand what IRR and MIRR, and you can understand profitability index, and you can understand what the payback periods mean, not necessarily, absolutely, do the calculations, right? Try to wrap your head around it. But at the end of the day, if you can understand what they mean and how they impact the selection of a project, we're doing very good here. So please prioritize comprehension over everything if you can. So when calculating payback period, is the number of years required to recover a project's costs or how long it takes to get the business's money back. So firms establish a benchmark payback period. Projects whose payback exceeds this benchmark are rejected. So when you do a payback period, it's the number of years before a full recovery plus unrecovered costs at the start of the year divided by the cash flow during the recovery year. Again, probably seems confusing, but if I show you how to do it in Excel, you're gonna be like, wow, that's easy. So what it looks like here is when you plot it out on a timeline, what you're looking for is you see your cash flow right here. This is your initial cost, right? And then this is the cash inflow at year one. So this is the cumulative cash flow. So if I paid $1,000 like initially, and then I earned $500 in year one, I still have a cash flow deficit of $500 because I paid 1,000, but I earned back 500. So I still have another $500 left to earn back. Year two, I earned another $400. So I paid 1,000, I earned back 500, and then I earned back 400. Okay, my cash deficit has now only dropped to $100, okay? Now, somewhere between year two and year three, I've paid off my initial investment. As you can see, because my cumulative cash flow here, and I sometimes forget that you can't see where I'm pointing, has increased, and it's now positive. It's positive $200, right? So in the case between year two and year three, we've paid off the project. Now, at what point did we, between year two and year three, did we pay off the project? Well, in order to be able to calculate that, what we do is we basically take the deficit, opening, so that $100 deficit that we still had to earn back, and then we take the total cash flows we earned in the period, right? And we go that deficit divided by the total cash outflows. So the deficit was basically 1/3 of the cash inflows for that time period. Therefore, it was 0.33 of a year to pay it back. And this assumes a straight line payback. So basically, all it means is that, and I really wish I could slide these, but I can't, unfortunately. It's not that type of room. So if I jump up here, well, that works pretty good. Okay, so what I'm really saying, right, is year 0, year 1, year 2, year 3, and then, yeah, it's 3 years. I need to extend that a little bit, make it neater. Year 3, okay. All right, and my initial outflow is 1,000. Okay, so where's my fancy blue marker? There it is. So in this case, I earned $500. So this $1,000, right? My cumulative. I basically go this $1,000 here, and then I add on the $500. I still have a $500 deficit. Then I earn positive $400, right? I add that on. I'm down to a $100 deficit now, because 500 plus $400 is $900, right? 1,000 minus $900 is $100. That's my current outstanding deficit, right? And then I earn $300 in year 3 because it's not a perfect world, and I actually over earn back my cumulative cash flow. So if we think about it like this, right? I still have a deficit of $100 here, and then as of year 3, I have a surplus of $200. Why? Because $100 plus the $300 is equal to $200, right? So I've become profitable at some point between year 2 and year 3, okay? So in this case, what I have to think about is if I think it's okay, it's on a straight line basis. If I go that $100 deficit divided by the $300, total cash inflows that I make, what I end up getting is that 0.33, right? Well, what's 0.33 of a year? It's 4 months, right? So if I were to put this into, like, say, a rate of cash flow, I'm assuming here that every 4 months I get $100, right? So here I got $100, here I got $100, and here I got $100. I add 100, 100, 100 together, I get that 300. So therefore, as of 1/3 into the year, right, I basically earned back my project because I had a deficit, and at that point I earned $100. Okay. So what this means is it took me 1 year, 2 years, and then 0.33 of a year for a total of 2.33 years to pay back the project. So that's an undiscounted cash flow, and this is an example of one. Okay? I do hope that makes sense. Okay. So, strengths and weaknesses of a payback, right? Indicates a project's risk and liquidity, and it's easy to calculate and it's easy to understand. We can very clearly communicate this to anyone, regardless of their understanding of finance and whatnot, and we can very simply say, hey, you make back your $1,000 investment in 2.33 years. We don't tell them anything after because the payback period doesn't tell them anything. What happens after 2.33 years? Does this project go on for another 10 years? Does it end at year 3? We don't know. All I tell you is that you make your money back at the 2-year and 2.33 year mark, right? Or 2 years and 4 months. So it has its limitations, but it is easy to understand. Weaknesses. It also ignores the time value of money, right? This is not factoring in that this $300 that we receive. There's a difference between receiving $300 at year 0, right, or today, and $300 in 3 years, right? It's not the same. $1 today is not worth the same as $1 3 years from now. I can earn interest if I have that money today, whereas I can't. It's the opportunity cost I lose, right? So in that case, we have to also factor in that, when we're doing this calculation, we're not considering the time value of money. And it's also not necessarily related to investors' wealth. That dollar or that time period has nothing to do with the investor's wealth. It just tells them when they get their money back, not necessarily how much it increases their value like an NPV does, right? Okay, so this is where the discounted payback period comes in. And it doesn't fix the fact that, we don't know what happens after you get your money back, right? It doesn't necessarily tell you if it increases your wealth, but we factor in the time value of money to come up with our revised estimate of what it takes to earn back or how long it takes to earn back our investment on a project, right? So This is the exact same scenario, but this is as if we factored in the time value of money. So instead of using these dollar amounts like I did over here, what I'm doing is I'm present valuing them. So $454 is the present value of $500 at 10% at 1 year. So it's the present value today. $330.60 is basically the present value of $400 today at 2 years. And $225, right, is the present value of $300 after 3 years, right? So what we're looking at here is instead of using these values for my cumulative cash flow, I'm using these values for my cumulative cash flow. So I'm going the 1,000 here, and then the deficit, adding on the 454. Now I have a 545 deficit. I add on the 330. I'm down to a 219 or 214 deficit, whereas before here I was at a $100 deficit. My deficit's bigger because my cash flows are worth less because of the time value of money. And then here I do still become profitable, or I do still make my money back by the end of year 3. But my surplus is not. It's not $200. It's 220, or no, it's $10.05, right? So we do the exact same calculation. We go the deficit here, divide by the total cash flows, but we use the discounted cash flows, and we get 0.95. So it takes 2 years plus 0.95 of a year. Therefore, the discounted payback period is 2.59 years, right? I did also do this in my lecture working document, if I can pull it up. Here it is. I hope I did it. Okay, so this is the, and I'll release this so that you have this and you can go back and you can look at it. I also added notes in here for you so that you can track my calculations. But basically, yeah, it's at the point where your cash flow becomes positive, you just drag it and carry it over. When your cash flows become positive, your cumulative cash flow, that's when you do your calculation and you go basically, what is my cash, cumulative cash deficit, and divide by the inflows. Do not worry about my formula. Pretend you didn't see that. But yeah, so 2.33 of a year, or 2 years, 2.33 years is what it would take, right? And then I did for Project L as well, which they didn't do in the slides. Exact same process for Project L. My undiscounted payback period would be 3.33 years. Whereas if I do the time value of money, and I present value each cash flow, and then I do my cumulative cash flow calculation, right? But I use these numbers instead of these numbers, it takes slightly longer. And that's where I get my 2.95 years, right? 1 year, 2 years, still negative, and then finally becomes positive. I go just this divided by this. That's it. And then for this guy, it takes a little longer, so 3.88 years. So I just wait for it to become positive, and then when it becomes positive, I just go this divided by this. That's all it is. So that is discounted versus undiscounted payback periods for projects. Okay, so evaluating payback and discounted payback. So projects with shorter payback periods are preferred to those with longer ones. And payback methods have serious faults as ranking criteria. You don't know what happens after you earn your money back. All you know is when you get your money back, and that is it. And yeah, it's not a full picture. It's only a partial picture. It's not like NPV. So conclusions on capital budgeting methods. Most large sophisticated firms calculate and consider all of the measures discussed in this chapter: NPV, IRR, MIRR, profitability index, payback period, and discount payback period. Each one provides decision makers with somewhat of a different piece of relevant information. Most popular is 9 times out of 10, it's always going to be NPV. NPV is generally the best. It's very holistic. It factors in all your cash flows. It factors in your weighted average cost of capital, and it tells you how it increases your wealth today. It brings in everything, right? Whereas IRR it's ranked second because it's a rate of return on your investment. And then MIRR is kind of, it's like a better IRR. So I actually prefer MIRR, if we're being honest. Then you don't have to worry about the issue with having 2 IRRs when you have a project with a curved NPV profile. Profitability index indicates the project's risk, and then PB, payback period, and discounted payback period indicate both the risk and liquidity of the project as well. Okay, so the decision to process. What is the source of a project's NPV? Well, there's quantitative methods such as NPV and IRR, and they should not be used as a substitute for sound managerial judgment, right? So it's like a lot of the cases with accounting. Whereas in accounting, what I can do is I can pull up a financial statement. I can put, say, budget versus actual, and I can say, oh, we've overspent in this area by $1 million. We've underspent by $500,000 here. Maybe, right, in the case of accountant, I don't always necessarily know exactly what that means. I can tell you that there's a problem. I can tell you that something happened, but I can't tell you why it happened, right? It's the same thing with NPV, IRR. I can give you these metrics, but these metrics don't replace sound managerial judgment. You still have to do your analysis. If we're achieving an IRR of 30%, is it ethical, right? These are all things you have to consider. These are meant to provide solid backing for management judgment, but they don't replace the management decision-making process. You can't. You still have to go through the processes associated with proper decision-making, and you can't just base it purely on financials. And this is coming from accountants, so believe me, it's true. Okay. In a perfect competitive economy, projects with high NPV result from some market imperfections only, and managers should strive to develop non-replicable sources of competitive advantages as well. That has to be factored in. So, business practices in Canada, NPV or IRR was not used much before 1970s. I believe it was mostly payback period methods. And then by 1995, majority of firms had adopted the discounted cash flow methods. It was mainly NPV and factoring, and also the time value of money as well. So while NPV is the single most important method, all methods are still used to come up with a balanced understanding of the viability of a project. So special applications of cash flow evaluation, comparing projects with unequal lives, and then economic life versus physical life, right? And this sometimes comes with capital investments as well. The unequal life one, it gets interesting, because what if you have a project that's only 2 years and then you have a project that's 4 years? Well, how do I evaluate the 2-year project one against the 4-year project? What if I just did that same project twice? Can I do that, right? Is a replicable project, right? I have to consider those types of things. So when there is a largely different useful life, there are some other factors you have to consider. So when you compare projects with unequal lives, it is often the case that two mutually exclusive projects will have significantly different lives. So say mutually exclusive projects with unequal lives and your required rate is 10%. Project S, and same initial outflow between Project S and Project L of $100, but Project S earns $60 in year 1, $60 in year 2, and that's done, right? Whereas in Project L, we earn 33.5 from year 1 to year 4, right? In a consistent uniform basis. So which one's better? It's hard to say, right? Because Project S is done in 2 years and I earn back my money really fast. Whereas Project L, it's much more extended, right? And it takes longer. But it looks like, from a high level here, we can tell that there is a gross, higher level of cash flows here. I believe Project S looks like it's about 3.5. Well, yeah, there are substantially more cash flows here, right? So if I do, the NPV analysis of Project S versus Project L, what I end up with is an NPV of 4.13 for Project S, and then for Project L, again, NPV of 6.19, right? So in this case, we're showing that Project L is more attractive, right? It's worth more in today's dollars, but there is that factor that, yes, that may be true. Project S is also wrapped up and done a lot faster, and I get my money a lot faster as well, right? So is Project L really better, right? And that's factoring how fast I get my money. So rationale with the equivalent annual annuity method is, Project S with a short life may be replicated at least one time during the long life of Project L, right? So what if instead of doing this, What if, I did project S twice in the time it took me to do project L once? What if at year 2 I invested another $100 and then I earned another $60 in year 3 and another $60 in year 4, right? So in this case, what's more my annual NPV, right? As opposed to total project NPV, what's like my annual NPV? And that is basically what this is. It is what's my equivalent annual annuity, or basically what's my average annual NPV on this project, right? So L's NPV should be compared with the sum of two S's NPVs. If we were to factor in that you could do S twice in the time that takes to complete project L, a simpler alternative is just to do the EAA, the equivalent annual annuity method. So the calculation of EAA, it's basically the payment method, right? If you've done payments in a financial calculator, if you've done the payment formula in Excel, you just plug in the number of years, you plug in your discount rate, and then you have to use your NPV, which you'll already have, right? So in this case, we're using a present value of 4.13. And then for L, we're using a present value of 6.19. Those are the respective NPVs. And then we use a future value of 0. And then we just solve for payments, right? So on average, S has an average NPV per year of about 2.38, whereas L, the longer project, has an average NPV per year of about 1.95. So yes, we get a higher NPV with L, but when we look at like rate of payment, we get our money way faster with project S, and we have on average a higher NPV per year, right? So think about it like this. Would you rather, right, earn, say, I don't know, $100,000 this year and $100,000 next year, or would you rather earn $50,000 over the next 4 years? Think about that, right? So you're probably going to come back to me and, well, the clever student, one of my accounting students might ask me what their tax rate is. Something to consider. But aside from all those things, high level, you're probably going to come back to me and you're probably going to say, I'm going to pick $100,000 in year 1 and $100,000 in year 2, as opposed to $50,000 from year 1 and year 2 and year 3 and year 4. Because if I earn my $100,000 in year 1 and $100,000 in year 2, in year 3 and year 4, I'm free. I can go and I can do another project. Maybe I take on another project where I earn another 100,000, or at least another 50-50, right? I have extra time. And because I'm making the most of my time. That's the argument with equivalent annual annuity, is what's my average NPV per year? Based on my time frame, am I making the most return I can? And with that extra time that I have, maybe I can make more when I have it, right? So that's what an equivalent annual annuity is. So conclusions about unequal lives does not arise from independent projects. It can arise in mutually exclusive projects with significantly different lives. Even for mutually exclusive projects, should be done only if the projects are very likely to repeat. And then if project S isn't going to double, it's not worth it. If you can only do it once, you wouldn't use this method. It doesn't make sense. And several potential serious weaknesses are inherent here. Inflation, new technology, and then it's more difficult to estimate the series of projects, right? If you're going to tack on a series of projects, well, then you have internal dependencies. Well, if one project goes late, it pushes another project. Believe me, that's the world I work in. It's not fun. So it's not simple, unfortunately. So then we have economic life versus physical life. So projects are normally analyzed under the assumption that the firm will operate the asset until the end of its life. So consider a project with a 3-year life. If terminated prior to year 3, machinery will have a positive salvage value. Should you always operate for a full physical life, right? Maybe not necessarily. It's not always the right decision to run an asset into the ground. In this case, if I look at the cash flows for a piece of equipment that I buy, and I look at what I initially pay for the equipment, right? So I initially pay $4,800 in year 0, and then I earn $2,000 in year 1, $2,000 in year 2, and then $1,750 in year 3. My salvage value at year 0, well, it's just the value of the equipment, right? 4,800. My salvage value at year 1 for the equipment, and this is what I could get for the equipment. It's basically the fair market value what I could sell the equipment for. I could get 3,000 for the equipment in year 1, or I get 1,650 for the equipment in year 2, or I could get $0 for the equipment in year 3 and just burn it right out, right? So if I don't terminate the project, right, and I run the equipment down until it's basically worth nothing, this is what my cash flow would look like. It would look like 4.8 million outgoing, and then 2 million inflow in year 1, 2,000 inflow year 2, and then 1,750 inflow in year 3. If I terminate at year 2, I would be 4.8 million, 4,800 bucks outwards in year 0. I would get 2,000 in year 1, and then I would get 3,650 bucks in year 2, right? And that is the 2,000 plus the 1,650 that you see here. I get my cash flow, and then I would salvage it as well, so I get the double cash flow. But if I terminate in year 1, I would basically pay 4,800 bucks today, and I would get $5,000 as inflows in year 1 and be done, right? And that is the 2,000 cash flows that I make, then salvaging the equipment for $3,000, right? What's the best option? Well, if I go to the full 3, the project basically loses value to the firm and to the tune of about 14 bucks. If I terminate and I sell the equipment at year 2, this project will provide $34 in value, in today's value, to the firm. But if I terminate the project right at year 1, it'll generate a $254 loss for the firm, right? So technically, it makes the most sense for us to buy our equipment, hold it for 2 years, sell it, and not run it down until it's worth nothing. Sell it when there's still 1 more year left of value on it, and we can maximize our earnings. This is kind of what a net present value profile might look like on projects with varying lives. It doesn't always make sense to buy equipment and run it down until it's worth nothing. Sometimes you buy it and you sell it at the point where you maximize your cash flows, whereas you also maximize what the salvage value would be, aka your sales price as well, to maximize the overvalue of the project to the firm. So the project is acceptable only if operated for 2 years, and a project's engineering life does not always equal its economic life. Economic life is when we maximize the value of the project, whereas the engineering life is more so how long can this car run for until the wheels fall off and the frame rusts through and the engine falls out, right? So it's not necessarily the same. It shouldn't be assumed to be so either. So the optimal capital budget, finance theory says to accept all positive net present value projects. And then so the optimal capital budget consists of positive NPV projects to maximize the firm's value, and then 2 problems can occur when there is not enough internally generated cash to fund all positive NPV projects. So you have an increasing marginal cost of capital, and then you also have capital rationing as well. So when it comes to capital rationing, it basically means that you don't have enough money on hand to finance every project. So if you finance every project the second you assess it as positive, and right, what you're doing is you're just going to take, it's going to be first come first serve, and that's never a good idea, right? We should probably accept the project that has a $1,000 net present value over the one that has a $50 net present value. But if I just do first come first serve, I'm just going to automatically accept the 50 and not wait, say, a month till the much higher net present value project comes in, right? So it's better for capital when you're maximizing the value of your funds that you have available. You want to kind of rank your projects and pick the better ones. And if you're constantly financing your projects, well, the more you finance, the higher your cost of capital gets, and then your higher weighted average cost of capital gets, right? So you want to plan these things. You don't want to be sporadic. You don't want to be constantly getting more financing to finance your projects. That almost never leads to a good place. So an increasing marginal cost of capital. So externally raised capital can leave large flotation costs, which is increasing the cost of capital. Investors often perceive large capital budgets as being risky as well, which drives up the cost of capital. And if external funds will be raised, then the net present value of all projects should be estimated using the higher marginal cost of capital, right? So if you remember, weighted average cost of capital is based on the future capital structure, because when we calculate weighted average cost of capital, we're focused on what are our future costs of finance. We don't use our current capital structure, right? Same thing for here, right? So if we're going to bring on $500,000 to finance our portfolio of projects, we have to factor in that $500,000 in financing, right? It's going to come at probably an increased marginal cost of financing. We have to factor that into our hurdle rate. So it's going to drive up the cost of our projects as well. And it might actually make some projects not profitable anymore. And then capital rationing basically occurs when you only have so much money to invest. And yeah, it sets an upper limit on the total amount of expenditures that you can make during the year. And that's very common. Firms also have a reluctance to issue new stock. They want to avoid the direct costs of, the flotation costs. It's not free issuing stock. Sometimes, depending on the amount, underwriters will take 11% off the top. So sure, you raised $100 million, but they keep 10 and you only get 90. So how efficient is that, right? Well, your flotation costs drive up your capital cost structure. So a solution might be to increase the cost of capital by enough to reflect all these costs, and then accept only projects that not only meet the required return of our investors, but also wipe out the flotation costs as well. So that's one way we can factor that in. But flotation costs are another thing to consider. It's not always cheap going and getting new financing. You have to factor in that there's costs of acquiring, legal costs, right? And there's also constraints on non-monetary resources, right? Maybe the firm doesn't have enough management or enough marketing or engineering staff, right? You can't just take every single project. This is where critical resource analysis comes in, bottlenecks come in. You have to look at what are your critical resources, what are their capacity, and you have to maximize the value of that critical resource to only work on the most valuable projects. Because if you have, say, your software engineers or your senior development officers, right, or application officers, sorry, specifically working on low value projects, meanwhile they're tabling high value projects, you're just robbing your firm of value. That's all you're doing, right? You have to have there has to be plans here. It can't just be the most valuable ones. And then also controlling estimation bias. So firms believe that the project managers forecast unreasonably high cash flow estimates, so they filter out the worst projects by limiting the total number of projects that can be accepted, right? So solution is to implement a post-op process to tie managers' compensation to subsequent performance, right? So this comes down to it reduces the kind of the motivation to overestimate cash flows on projects to make them more attractive, right? Because if a manager says, this project's going to generate $1 billion in cash flow, you're like, really? That much? You sure? They're like, yep, absolutely. We're like, okay. You will only receive 50% of your compensation if this project produces less than $1 billion in cash flow. Oh, okay, maybe not, right? So at that point, that's when they might take a step back and they might say, maybe I need to be more conservative, right? They're not just throwing out high numbers so that you accept the project. They're actually critically thinking about it because it's also tied to their personal success, right? So that is one thing to consider as well, is tying compensation to project estimates and the post-audit process of projects to reduce bias. So here is the summary. I really feel like I've really beat this one to death a little bit here, but we have the NPV, the IRR, MIRR, payback, our profitability index, payback period, discount payback. We talked about equivalent annual annuity, and then we've also talked about a couple factors to consider in the process as well. This is it for capital projects. I believe, so I have a couple documents here, right? I'll release this one, which shows me doing all the calculations that you would find in this, in the PowerPoint. And then I also have done this. This is the first problem set for my first class. And it basically goes through and I do the first couple problems. I do some examples of payback periods and discount payback periods and net present values. I also do some IRR calculations. So it's kind of like applying this stuff, but to kind of more complex situations. These are pretty much the easier problems. And then I did do a couple hard problems. And again, I'm happy to release these documents. These are my own working documents that I built so that you can understand how these things work, right? At the end of the day, my priority is that you understand this material, and this is just one way I think I can help with that. Yes, go ahead.
I have a question. So after this class, when we going to practice all these questions, if we have any queries or something, we're gonna ask you in the next class, correct? Like for the especially for the calculation and everything, because me personally have like I find difficulties to find calculate sometimes, so I'm going to try after the class every single thing, all these powerpoints and everything, and if I have any questions or something, do I just email you or wait for the next class?
Yeah, definitely shoot me an email. That way I get an idea, right? So if people send me emails, I kind of have an idea of where people are struggling, and I can prep myself for the next class, right? I'm not expecting you to do every single one of these problems, if we're being completely honest, right? I have to release a document, right? With these problems so that you have them, because this is actually a future version of your textbook that I'm using. So I'm going to release that as well along with these so that you can kind of work through it and you can kind of reverse engineer what I'm doing. I'm really hoping that this isn't too strenuous. Focus on the easier ones first, and then if you get those ones, go ahead, move on to the harder ones, see if you can get those ones, right? All these problems, these Excel documents I built, so for my previous section, I've built up those students over a long period of time working in Excel, right? Working with these types of formulas, where I haven't had that opportunity with this class, right? So I don't expect you to feel like this is going to be a breeze. Definitely give it your best shot. If you have questions, shoot me an email, and I'm happy to go over anything prior to the next lecture as well. And we can discuss it, because this is one of the longest lectures, and we got through this one and we still have some time to spare. So I can absolutely make time at the start of any class to discuss anything that you want to chat about, for sure.
Perfect, thank you.
No problem. Anyone else? Okay. I'm gonna stop my recording.